Hey, it's Jack from Jack Gately Real Estate and the Online Real Estate Academy. So in this video, we're going to talk a little bit about the updates in the lawsuits that are gripping the industry. Quick update about that. And then we're going to get into the economy and mortgage rates. And we are right on the eve. We're right on the cusp. Well, we're in it. We are in the spring market. So for those of you who are from the northern part of the country, spring is sprung, right? In many places, a beautiful day today here in Boston or in Massachusetts. I walked through the Boston Common today. It was fantastic. I wasn't chilly at all. Spring is here. We have next weekend is the first weekend in May, which is usually when we see a lot of new property come on the market. I have a house that's going to come on the market this upcoming Monday. We're having an open house the following week. Right, a lot of spring activity. I did not check the inventory numbers before I went live today, but I did check them like 2 days ago, and we were still at the same number that we were at this time last year, which was about 3,400 single-family homes for sale statewide in Massachusetts. That would be about a third of what it was, say, in March of 2020. So, like St. Patrick's Day is kind of when everything hit of 2020. So that's like a third of what we had in March of 2020. So, yeah, inventory is amazingly, and even then it was kind of tight, but now it's just like crazy tight. And this is usually, given a normal spring, where we would see an increase in inventory and activity. Everyone comes out of their hibernation, right? But we will keep a very close eye on inventory as we go forward from here. Yeah, we're live streaming. We are live streaming. No one's with us today yet. Okay, well, hopefully you'll join any second. I thought there was something wrong. But no, I don't think there's anything wrong. I think just no viewers. I'll get over it. All right, so Home Services has settled for $250 million. That does not mean that Berkshire Hathaway Energy, which is really the big pockets here, the Oracle, he has not settled, and they still might be on the hook. Then Realty One in Properties, or at Properties, what an awful name, reached settlement in the commission cases. So that's more settlement. Everyone's running to settle. There are two other lawsuits here happening, and those are the Gibson and Umpa copycat cases. They have now been consolidated. Okay, good. And we have some input here from the National Association of Real Estate Brokers, which I don't think I've been familiar with before. The National Association of Real Estate Brokers represents Black real estate professionals who could face new challenges, said the president, who is, what's her name here? I want to get her name right. Dr. Courtney Johnson Rose. And she said, if a rise in pocket listings occurs, that could increase the amount of potential discrimination in the market. Well, that would not be good. That would not be good. We don't want that. And how do I want to say this? Remember the story out of Long Island where we had a couple of years back where, like, literally caught on tape, real estate agents were sending white applicants this way or white buyers this way and black buyers that way. That was horrifically open and racist. That was awful. And I said so at the time. And I would hope, I said this then, but I would hope that we have known better as a society, but apparently not. And I am sure some things like that still occur. And that's probably why this organization exists, in part to kind of protect against that or call that out when it happens. But that was just an awful thing that happened in Long Island. And I'm sure it's not probably the only place that it happened. So they should continue to be vigilant. Should the pocket listing situation become some type of method for which to discriminate against buyers, that would be absolutely awful. So I'm glad that they're calling it out, raising the awareness. Maybe by raising the awareness, you can potentially mitigate any type of ugliness that might go along with that. So the The Fed's favorite inflation gauge rises faster than expected in March. That's bad news. I don't like that news. And next headline here. Key Fed inflation measure rose 2.8 in March from a year ago, more than expected. U.S. economic growth slowed in early 2024. So we had some GDP numbers that came out yesterday, shows surprising slowing in an uncomfortable inflation. So I believe our growth number that came out yesterday was 1.6 for the quarter, and the prior quarter was 3.4. And I think we're expecting a number somewhere in the twos, if I'm not mistaken. Yeah, where I think we're expecting somewhere about 2.4. We had a slowing growth in the economy in the prior quarter that we just finished. That was not good. And here's some more headlines. Markets fall as investors worry about low economic growth and stubborn inflation. So there's a name for that, low economic growth and stubborn inflation. That's called stagflation. Let's bring up our favorite chalkboard here. Let's see if we get this right here so you can see it. Hold on a quick second. Oh, I should have had that sized properly before I hit the live button, but that's all right. You'll give me a quick second. I know that you're patient. Appreciate your patience. And we're almost there. So, yeah, that's better. No, that's worse. Okay, so basically, what our Federal Reserve overlords want is low inflation, which would be nice, and a booming economy or some type of activity in the economy. But what seems to be starting to creep into the reality is something on the other side of that, which is higher for longer and a slowing economy. There's a nickname for that. That's called stagflation. That might be a word that you might start to hear a little bit. People start to suggest or defend against. Here's one of the key things that I've noticed about the financial news. Whenever there starts to be a narrative that something might go wrong, I heard this on CNBC the other day. They always roll out the experts to tell you it's not going to happen. So yesterday I'm watching CNBC right here, the little television's right over there. And I'm watching guest after guest yesterday afternoon poo-poo the concept of stagflation. Steve Leisman, one after, oh, that's not going to happen. That's not going to happen. These are the same folks that told you we were going to have 6 rate cuts this year, right? It's just like they continue to tell you that this is not going to happen, even though, you're reading the headlines, and it certainly seems that we seem to be headed for some stagflation potential. Even Jamie Dimon says he hopes for a soft landing, but says stagflation is possible. Again, stagflation, just to, I know my chart didn't work. Sorry about that. Stagflation is when we have a slowing economy with high inflation, like the 1970s. I was a kid in the 1970s. I remember it. We had 2 periods of inflation. Inflation went up, and then remember, it never really goes away because it's cumulative. And then inflation went down, and the Feds thought they beat the inflation, and then they cut interest rates. And what happened then? Inflation went right back up. And so they don't want to make that same mistake again. And it seems like inflation is going right back up without them even cutting the rates. And that's, once again, as we've talked about on this channel, because there's just this undeniable truth. And the fact of the matter is, our federal government is spending absolutely out of control. This is just objective reality. It's not a partisan thing, because I think both parties are well to blame for this. There are some less than others, but both parties have their hand in the cookie jar. And our debt, our interest on the debt is just, it's just mind-boggling going up. And every time we borrow to pay off debt, we're borrowing to pay off debt. We're borrowing to pay off debt. There's a death spiral aspect to that. And it seems like we are now entering the death spiral, right? That's just like hard to believe, but it seems like the chart is just like this. So that means that we have to pay more to borrow because people are nervous about us paying it back. And that is reflected in what we call the 10-year treasury, the 10-year treasury. So the 10-year treasury at the moment, this afternoon at 3:09 p.m. is at 4.669. We'll just 4.6 and change. And that is the premium that the federal government is paying. If you give them money, they will pay you 4.669% for a 10-year treasury bond. And that's nice and steady interest. It's typically considered low risk because, of course, the federal government always pays its debts and always will. Right. And except that's why the rate is going up, because people are becoming less convinced that they're going to pay the debt. And also, they become fewer buyers of that debt. As the number of buyers goes down, then the price goes up, right? Right. Okay. So that's how that works. So our mortgage rates closed today at 7.45. And that's actually slightly down about 0.7. I think our peak this week was 7.52. And if you're not sure, you can always check the Twitter feed, the X feed of Lance Lambert from Resi Club, my favorite my favorite website, or one of my favorite new websites, Resi Club. And not sponsored, should be sponsored. They should sponsor. They should at least give me a free membership. And the average 30-year fixed rate mortgage slips to 7.45 heading into the weekend. And then there's this thing called the spread, which we've mentioned before. And you could always kind of just go to Lance's Twitter page, X page, to find out what the spread is. And so the high for this calendar year was 7.52, which we mentioned, and the low was 6.63 this calendar year. Now, the spread is an interesting thing. The spread can go down as low as, say, under 200. And I think I've seen it recently in the last year or so as high as about 315. Now, the spread basically represents the additional risk that's involved with mortgages. So if the federal government pays off its debt, we all know that some people are going to have trouble paying their mortgage off, right? Right. Not most people pay their mortgage, of course, but there are certain situations where people get foreclosed in, unfortunately, or foreclosed on, I should say. And that additional premium above the 10-year note, which is basically, people take a mortgage for something about that many years, represents the measurement of risk for foreclosure. So there's really actually at least two factors that make up the spread. One is the long-term risk. How many people are going to default and get foreclosed upon in a 10-year period, we'll just say, theoretically. And then there's the short-term risk, which means, if I get this right, remember, how you lock in your rate today, but you might not actually close for another month? So there's short-term risk to that for the mortgage company, that maybe rates go up in the next 30 days. It's the cost of a rate lock, right? And they always tell you, if it goes down, we'll let you go to the lower number. But if it goes up, So you know how that works. So they run risk there on the short term when they're locking in a rate. And so the spread represents at least both of those things, the long-term and the short-term risk differential versus the 10-year. I hope I did a good job explaining that. And there are times where the 10-year will go up on any given day, where this number here in the big bold would actually go up, but the mortgage rate that's quoted over on Mortgage News Daily on any given day might actually go down. And the reason is because the market is factoring that the risk actually went down more than the yield went up. Maybe I should say that again. On days where the bond yield goes up, but mortgage rates go down, those are days where the market has determined that the risk differential has actually decreased more than the yield has gone up. Yeah, good job, Jack. So we see those things happen where the yield goes up, but mortgages don't really move that much or in a direct proportion. So there's some fudge factor to that. But when you look at the chart, there's no telling. It's undeniable, I should say, when you look at the chart, that we had a peak sometime in late October that shallowed out right about Christmas. And then since then, we have been on a surge, especially since the beginning of April, upwards in the 10-year note. And if you flip to the mortgage chart, 30-year mortgage chart, you'll see the exact same thing, right? You'll see the exact same thing. Up we go, starting with April. And of course, there's technically no limit to how high that could go. There's no law about that. It's all about the risk and how many people want to buy 10-year notes. And the simple fact of the matter is our federal government is just spending so wildly that we are here in an environment where it's highly likely we're going to see 7% for a long time. Now, we might have occasions where we dip down to 6.9 like we did not that long ago, or even down to 6.7 or something. But if for those of you who think that we're going back to 6.25 or 5.75 anytime soon, how do I want to say this? You're high as a kite. I don't think that's going to happen. That's just that's probably not going to happen unless, like, we have a major change in direction here with the economy. Don't see that happening. So as we head into the spring market, which is how I started off this diatribe, and thank you so much for the two of you that are actually watching the live stream today. I thank you for you. This is really bad for the spring market and for buyers. I'm concerned. I've been on the phone with buyers all week. There's a hot time to talk to buyers. And I've had some buyers that haven't talked to their mortgage guy or girl for 3 or 4 weeks. And I'm like, you might want to do that right away. But I have this letter. They wrote me a letter in middle of March. Yeah, you might want to revisit that right away before we go see some open houses, because the numbers have changed. And they're like, oh, really? Yeah, get back to me right away. And you as an agent, you don't want to be showing property that that the buyer can't afford anymore. And if basically rates are 0.5 or 0.6 higher than they were 30 days ago, that might affect somebody's affordability if they're right on the bubble. So please be mindful of that. If you're an agent out there, make sure that they're in constant contact with their mortgage officer so they know exactly what they could borrow. And as always, just because you can borrow it doesn't necessarily mean you should be borrowing the maximum amount, right? Speaking from experience, just because they tell you can borrow a certain amount doesn't mean you should borrow it, right? I made that mistake myself when I bought this house. And then again, because the strategy was to buy this house and keep it forever, as we say here in Boston. I guess that was a mistake back in 2002, but now 22 years later, I've mitigated that mistake by keeping the investment for so long. All right. So let's see. Someone says, Jeffrey wants to know, are we going to 8% rates? And as some of you might remember, that we did hit 8% was it last summertime? I think it was last summer. Let me just pull that up for you. It was no, it wasn't last summer. It was October 18th. October 18th of last year, we hit 8% for a split second, and maybe even 8 point something for a split second, a day or two, and then we came back down. That was the peak. Do I think we'll see 8% rates again? Is that what you're asking? You're putting me on the spot? Yeah, I do. I think we will see 8% rates, just because our fiscal house from if and I wish I had this chart for you today, but just like this, like we are entering this death spiral situation where we're borrowing so much money just to borrow more money. If you we are on like our 98th credit card. If that makes any more, is that an analogy for you that makes sense? I hope so. It's incredibly scary to the point that this does become a national security issue. It becomes maybe the number one issue lurking in American politics and American life, what we're looking at in terms of our debt situation. And, again, this is not a partisan thing. I think both parties, all parties, everybody, you and me, everyone's responsible for this. It's looking really bad. And I do think we're going to see much higher interest rates. Yes, sadly. Sorry to tell you that. But yeah, I think that, Jeffrey, thank you. Trust me, I'd much rather us go back to 5.25, right? But I just don't see that happening. 7.45 sounds really high today until it's 9, right? And let's keep in mind that if you look at the 50-year chart, can we look at the 50-year chart? I wonder if we have a 50-year chart on that. If we look at the 50-year chart on mortgage rates, will they give that to us? Yes, here they go here. Here we go here. Mortgage News Daily, thank you very much. When you look at this 50-year chart going back to the 1975, where we are currently is we're still on the bottom side. We're below the median. If our interest rates now are something like 7.5 or a little bit under 7, historically going back, look at these numbers from the early 80s, 17 something percent. So, 8-9% it sounds inconceivable right now, Jeffrey. But because so many of us adults lived with interest rates at like 2.2%, and we kind of thought that was like some type of law that came down from on a tablet. And if you're 20 to 40 years old, you're probably thinking that is the law, that it only went to 17% back in Grandpa's day, right? I remember when Grandpa told me about mortgage rates that were 17%, but now in the modern era, that could never happen. Oh, yeah? Really? Is there did it come down from? No, it did not come down from a tablet. The only thing that matters is the market. And, I could definitely conceive us going to 8 or 9%. Yes, sadly. But all of that would almost be completely self-inflicted based upon our spending at the federal level. All right, so I want to keep that in mind, all of you. And I hate to end this week's videos, which I thought I've done a great job on this YouTube channel this week, as a bummer. But I just think that that's where we're at. And let's call it as it is. And good luck with your buyers. Make sure they stay in touch with their mortgage representative and go out and sell something this weekend. I have an open house. I got a bunch of customers I'm helping this weekend, and looking forward to putting that house in the market. My agents are busy, so go make some money. Have a great weekend. Happy spring. Thanks for joining us today. Bye-bye.